Ladies and gentlemen, good day and welcome to CSB Bank's Q2 FY25 conference call hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shivaji Thapliyal from Yes Securities. Thank you, and over to you, sir.
Thank you, Siddhant. Good evening and a warm welcome to all those who have joined the call. The CSB Bank management is represented by Mr. Pralay Mandal, Managing Director and CEO, Mr. Satish Gundevar, Chief Financial Officer, and Mr. B.K. Divakara, Executive Director. We specifically thank the management of CSB Bank for giving Yes Securities the opportunity to host their result call. The management will first be making some opening remarks, after which we will throw the floor open for questions. I now invite the management to make their opening remarks. Pralay, over to you.
Thank you, Shivaji, and good evening to everybody. I would like to especially thank everybody for joining our call today because there are so many results today, including BFSI. So people have taken time out to join our call. We are very thankful for that. So I will give a very brief understanding of what's happening globally and in our domestic market and then quickly move into our results. So globally, the economy is heading towards the year end with unexpected tailwinds as slowing inflation clears the path for a soft landing. However, the impact of geopolitical hurdles that lie ahead is a key monitorable. Globally, oil prices have also eased a bit despite the ongoing global tensions. And US 10-year yield has also gone back above 4%. Gold prices are touching new highs and is trading reasonably above 2,700 levels in terms of dollar terms. The biggest support for the dollar over the last few weeks has been a shift in the Federal Reserve policy expectations to a more moderate easing phase after a slew of solid US economic data. And markets are widely expecting Fed to further cut rates by 25 basis points in November. On the domestic side, after the Fed rate cut of 50 basis points in September, dovish outlook had estimated the financial markets in India as well. However, RBI maintained the status quo on the rates while changing the policy stance to neutral. Though retail inflation in India has been volatile and industrial output was marginally negative, growth outlook remains stable. With such economic and geopolitical background, an immediate rate cycle by easing by RBI is not expected, and we have to wait and watch for any rate action by RBI in the next few MPC meetings. The recent statement by RBI Governor probably leads to status quo for some more time. However, the surplus liquidity condition may prevail for a while. Coming to CSB specifics, highlight of performance of Q2 FY25 are on the profitability. Net profit 138 crores, up by 22% Q on Q and 4% YOY. Bank continued with the accelerated NPA provisioning policy of making provisions over and above the RBI requirements and holding the contingency provisions intact. NIM sustained at 4.3% of the quarter for the quarter, despite the cost of funds going up universally and regulatory guidance on penal charges. ROA was around 1.5%. On the liability side, we improved the funding base significantly. Deposit grew by 25% YOY as against the industry growth of around 12%. CASA ratio stands up marginally above 24%. Asset growth, net advances grew by 20% YOY against the industry growth of approximately 14%. Gold portfolio registered growth of 28% YOY. Yield on advances for Q2 FY25 is at 11.21% with an improvement of 33 basis points from Q2 FY24. On the asset quality matrices, I think it has remained reasonably flat quarter on quarter on most of the parameters. So slippages has been significantly lower compared to the last two quarters. And GNPA has been 1.68%, NNPA has been 0.69%, and almost sustained at the June level. PCR now stands at 81.49 and 15. If you consider the PWO, and if you don't consider, it's 59.45. Bank is holding a provisioning buffer of around 183 crores over and above regulatory requirements. And this is a very key point because there are ways and means by which we could have used some of these things to improve our PCR, but we decided that we will have a conservative policy on this, and we continue to hold the additional provisioning in addition to what we are doing on the provisioning side. On the robust capital base, we sustained that. Our CRR is 22.74 and Tier 1 is 21.37. Low proportion of risk-weighted assets has been sustained compared to the industry. On the shareholder value creation side, book value per share is at 229. EPS for the quarter is 13.65 and ROE we almost touched close to 15% at 14.53%. On the distribution, we have a network of 802 branches and 770 ATMs as of quarter end. We have added 23 new branches during the first half year, and on a year-on-year basis, I think we have added more than 90 branches in the last 12 months. On the branch expansion side, I think for the fiscal, we are on track, and the same will be completed as a plan in the second half, because generally second half is heavier in terms of branch expansion like it happened last year. In conclusion, I would like to say that the good thing about this quarter gone by is we are back on track as far as the guidance on the business growth is considered, which is growth of 30 to 50% higher than the system trend. Actually, we are significantly higher than that this quarter. The strenuous effort taken towards maintaining a balance in terms of various regulatory ratios like CD ratio, LCR, NSFR, etc., and keeping sufficient liquidity for advanced growth has paid off. Borrowings are also resorted to an additional window of fundraising based on cost considerations. So while we didn't need to have more borrowings, but we did it just to ensure that we have a long-term sustainable growth on the credit side, because we cannot keep looking at the rear window and keep seeing that how much we need to grow, because that way we cannot build a franchise. That's why I said that even if it is cost inefficient, we'll continue to have a lesser liquidity risk in the bank for the long-term growth perspective of the bank. On the profitability side and asset quality numbers, ratios are pretty stable. Though the liquidity conditions have improved a bit, the interest rate on deposits continue to be at elevated levels, and we believe that that will continue for a while more at a systemic level. The attractive term deposit rates and inclination towards other investment opportunities like mutual funds, stock markets, gold, etc., continue to put pressure on the cost of funds of the banks at a systemic level, and we are no exception. And we are not able to fully pass on the same to the borrower given the competitive environment in the market. This, along with the regulatory guidance on the penal interest, continued to impact the NIM this quarter as well. But I personally feel NIM have sort of bottomed out for us, okay, and we should start seeing better days, maybe Q4 onwards on the NIM as well. We expect NIM, which is almost sustained at June 24 level, all other critical ratios like ROA, ROE, EPS, credit cost, book value per share registered improvement in Q2. Growth in other income was also good to negate the quantum increase in OPEX, resulting in better operating performance. The build phase progress is going to accelerate in the coming quarters with the planned implementation of CBS migration and resultant improvement and stabilization in the products, process, systems, etc. You would see one slide in the investor presentation when you have an opportunity to look at it, that we have put one slide on technology, which is basically giving clearly the rollout plans and the dates, because that is our biggest story, how we are rolling out the technology piece and how businesses from the current business mix, how it will go to the 30-30-20-20, which you keep talking about, how it will transform, will depend on this technology rollout. That's why we deliberately put one slide on the technology rollout piece for the first time in our investor presentation. While these investments will have an impact on the cost in the near term, which we can see, and we have been able to sustain around 65%. And in the long run, I have said that we'll bring it below 50 by 2030. Our endeavor would be to ensure results to accrue in the long-term run in line with the payback period estimated for each of these initiatives. With the continued cooperation from all stakeholders, we'll strive to deliver quarter on quarter in line with the expectations. So here I stop. This is broadly where our quarter went. Look forward to your questions from all of you. Thank you very much. Over to you, Shivaji.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Chinmay Nema from Prescient Capital. Please go ahead.
Hi, sir. Thank you for taking my questions. Just a bookkeeping question from my side. If I look at the retail book in the presentation, it's at 5332 CR. And the last quarter it was at 3541 CR. So that's a delta of about 1700 crores. So the disbursement number is at 300 crores for the quarter. So am I reading something wrong? Just want to check that, sir.
So there is a little bit of an echo. If I understood your question right, what you're saying is while disbursement on gold has been little lower, but book growth has been faster. Is that your question?
Yes, sir. On the retail book.
Yeah. On the gold or retail book, which you're talking about?
The retail.
In the retail book also includes the LAS portfolio. Here too, earlier, this LAS portfolio that is loan against securities, whether secondary security is a gold, was part of the gold loan book. From this quarter, we have included that as part of the retail book, and that's the reason that you are finding that difference.
Got it. So could you share the breakup of the retail book between gold loan and the unsecured portion, and what's the asset quality trend that you're seeing on the unsecured side? If you could share the Stage 3 numbers.
So, in our retail book, our breakup I'll try and give, but typically we have degrown our 3 businesses over the last 1 year. One is personal loan, one is two-wheeler, and one is microfinance. These are the 3 businesses, and hence some of the stress which you are seeing in the environment now, we saw it coming more than a year back. That's why we have this year consistently degrown these 3 books. Where it has grown is, we have grown CV, we have grown CE, we have grown, as they said, that we have reclassified the loan against security, which mostly is gold security as a security collateral. We have grown healthcare, and we have grown a little bit of a credit card based on a partnership basis, and also we have grown inventory finance. So these are the businesses which are pseudo SME kind of businesses which have grown. Pure play retail, we have definitely not ventured in troubled waters right now, because as a new entrant, we didn't want to be taking unnecessary risk. So we have done businesses which you understand and which our franchise can do, taking relatively lesser risk. In spite of that fact, we slowed down these businesses, but whatever business we did, we have seen a little bit of a slippage on the MFI side and on the unsecured side. But while for the system it may not be picking out, for us it will be picking out sooner, because we had started degrowing these businesses quite some time back.
Got it, sir. Got it. Thank you. I'll join the queue.
Thank you. Our next question is from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening. So firstly on the margins, so for H1 we have seen margins of about 4.3%. So do you still believe that we'll be able to maintain the guidance for this year, which is 4.5 to 4.8%, or And if at all, what will drive this improvement in H2?
Hi, Mona. Very relevant question. So, what has happened is, we knew that cost of deposits are going up in the ecosystem. So this is not happening to us only, it is happening to the entire system with the other banks also. And we have not been able to pass on the yields to the asset side of the business as much. But in spite of that fact, we could have done 4.5, which we had guided. But the penal interest, which is impacting us by somewhere around 25 basis points, has continued to impact us. So if you add that, 4.3 plus another 25, we would have been 4.55. So I think that's going to permanently impact us to a great extent, because we are not seeing, and even if we are able to recover, that will come back with a lag on the fee side. So technically, NIM will have this impact. Having said that, if you are able to recover some of our NPA portfolio over the period, we can't commit that, but we will continue to try that. And if we are able to reprice some of the books here and there, I think we can try and come closer to 4.5. But I think we have sort of bottomed out in NIM, but I am not seeing too much of an upside from here as well. So I think I will say that guidance will be between 4.3 to 4.5. Primarily because of the penal interest. Simple thing is that 25 basis points has been shaved off because of the penal interest reason. That's why it's not that the guidance was wrong, but the guidance has to be relooked at in view of the regulatory reasons.
So, not just for this fiscal, but even going forward, you feel that 4.3 to 4.5 will be a fairer assumption for margins?
I will reserve my comment on that right now, because I'll tell you, I'm hoping that come next financial year, we should be able to do better on the NPA compared to this year. Because either some of the NPA which we have booked in the Q4 and Q1, either we'll recover some of that or we'll write off some of that. Okay. And if we do that, we will be probably able to get some NIM back into the system. But yes, I think 4.5 to 4.8 looks to be difficult unless it can happen only sometimes mid of next year onwards, once the interest rate starts coming down and coming down faster than the yield going down. We have one advantage because I see for another 15 to 18 months gold loan continuing to be more than 40% of our book, and gold loan yields is not elastic. Our EBLR link book is not very high, and hence as and when the interest rate cycle reverses, probably banks like us will be able to retain larger NIM compared to banks which are more wholesale oriented kind of a bank, where EBLR linked or MCLR linked businesses are higher. And even retail businesses, even if they're fixed loan, but new businesses gets booked at lower prices, but businesses like credit cards, gold loans, etc., the elasticity is lower. And to that extent, we hope that once the interest cost starts coming down, if at all, sometime mid of next year, we should be able to get some benefit out of it in our NIM.
Sure. And so, with margins derived lower by 20 to 30 bits, how would the ROA guidance stand now, which was between 1.5 to 1.8? Would that also be lowered down by the same extent, or some of it is recovered in other income and OpEx?
Yeah. So if you see, our other income has retained around 18-19% of our overall income. So to that extent, I believe that, and also in spite of heavy cost investment that is going into technology and distribution and people and everything, in spite of that fact, we have been able to increase our ROA this quarter to 1.5%. My feeling is that we should be able to better than this, and hence in the range of 1.5 to 1.8, the guidance sustains, because we'll be able to build up other income and we'll be able to manage costs better. So between these two, I think we should be able to maybe lower end of this in this range. But I think if in this quarter we could go to 1.5, I think we should be able to do better than this. I'm not making a forward-looking guidance, but I'm just going to push the system for that.
Right. Got it. And while you partly touched on it, just wanted to check on this, the corporate slippages that we had last 2 quarters. What are the recovery prospects? Would it be possible to recover them this year? Or, generally, what are the prospects as well?
See, if you look at our slippages, trending on a quarter-to-quarter is looking better. The March slippages is 122 crores, June was 103 crores, and September is 62 crores. 62, and even if you add additional NPA and all that, it is 64. So from that perspective, I think the slippages are coming down, and some of the slippages which has got added now in this quarter, I can see are something which is trending downwards, like retail loans, agri MFI. There the books are shrinking, and if books are shrinking means the portfolio which is leading to slippages is unsecured MFI, agri, those kind of businesses. They are shrinking. So to that extent, I see slippages coming down. Some of the slippages also don't lead to necessary cost because that's the kind of arrangements we have. Some of the businesses have those arrangements. So given that, it will be net ROA net neutral. From some of the slippages do not lead to NPA also in our bank. So given all of that stuff, I see from an NPA perspective, unless there is something which is a surprise which is not known to me today, we should be able to retain at this level. And once we start booking the migration provision for some of the slippages which has happened or recover them, we should be able to see a slight downward trend on NPA over the next 1 year. Again, this is not a forward-looking statement. This is something which will work towards. But I don't see, and I've always said that gross below 2, net below 1, and credit cost below 0.4 will be well below that. That much I can say with a lot of confidence will be well below each of these three. Because you saw that this quarter we have reached a credit cost 15 basis points. This was around more than 20 basis points last quarter, 24 or something like that, 22 I think. So, and also I want to tell you that unlike last year, we have made one small change, which is the standard provision we have added into the credit cost. The last year data which was there standard, now that can be not too much, but I'm just saying that we have been more conservative in reporting on our credit cost now. So in spite of that 15 basis points, which is well below what we have been giving guidance on. So I think on a slippage, on a NPA, on a credit cost, we are looking good. And I hope that what you are asking me question, we can recover some of that. It will even look better.
Got it. And just one last question. So it looks like we've had some reclassification in the book this quarter. So if you could give like-to-like loan mix for Q1 as well for reference between corporate, SME, gold and other retail, that will help.
Yeah. So I'll give you a detailed answer on this. So more than what you're asking, I'll give you. The wholesale book has shown degrowth primarily because the DA portfolio is running off. A small portion is left now, around close to 300 crores is left. That will also run off in the next 4 months. So some LCBD businesses has come down, and we have also exited we are exiting some of the large corporate accounts which we don't like. They're not NP accounts, but we don't like them, so we're exiting. In fact, as we're talking, we have just exited one this quarter, a large account. So given that, in spite of the fact wholesale book is kind of a flattish, they are around 23% of our overall book, okay, which was, I think, was 26 or 25, 26% before. But now all that is done. So now next 2 quarters, now last quarter, which is Q4, you will see wholesale book starting to pick up from there, because fresh disbursements are happening significantly in wholesale and the kind of businesses we want to do, because now we have built up a good team with a good coverage team across the country, and you will see next year wholesale book will grow at a significant pace. On the SME side, it has sustained the kind of growth which we are doing, which we had committed last year. That all cleaning up we have done already. So they'll continue to sustain. They're growing somewhere around 23, 24, 25% in that range. I think they will sustain or do better. But on a conservative basis, I think SME book should be able to grow around 25%. Gold is growing around year-on-year around 28%. Last quarter itself, it has grown by 10%. So if I extrapolate that, it is much higher than 28%. But I think we should be able to grow by around 25 to 30% on the gold loan side. Retail, we are being conservative. So, as you rightly said, there has been some reclassification. And it's not done for any other reason. It is done for regulatory and other reasons that loan against gold, which are taken as security, okay, it has been classified as last business and not kept under gold business. But effectively, that collateral is gold, but this is not gold loan business. That's the way. So whatever we said that is collateral gold, but it is not gold loan business, we have reclassified under retail. And that portfolio size is somewhere around how much? 1,600 crores. So I'm giving full disclosure so that there is no confusion. These 1,600 crores have moved out of gold loans. If we had not moved it out, gold loan business would have been somewhere around 50% of the book, 52% or something like that. Just add 1,600 crores to that. But it is not done for doing anything else. It is just done to be on better side of the compliance. Okay. And rest is our MFI book is around 2%, Agri book is around 3%, and 15% is retail. And 15% of this retail includes this 1,600 crores of loan against security. So this is the full disclosure.
Right, just one thing. So, on this kind of disclosure, what is the sequential growth in each of the four portfolios? You could just tell us between Q1 and Q2.
Yeah, I'll tell you that. So, on gold, we have grown by Q-on-Q, we have grown by 10%. Wholesale, Q-on-Q, we have grown by 5%. Okay, I'll give Q-on-Q and YOY both together. That will help you. Gold, Q-on-Q, we have grown by 10%. YOY, we have grown 28%. Wholesale, we have grown Q-on-Q 5%. YOY minus 1%. And hence, you can see already in wholesale, we are reversing the trend. You will start seeing it from next quarter onwards. SME, MSME, 5% Q-on-Q and 26% year-on-year. Retail, 7% Q-on-Q, 45% year-on-year. But there is a noise in this, as I said before, because here we have the loan against security as gold. Agri, 4% Q-on-Q, minus 5% year-on-year. MFI, minus 6% Q-on-Q, minus 13% year-on-year.
Got it. Thank you so much. I'll come back to this. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Our next question is from the line of Sonal Minhas from Prescient Capital. Please go ahead.
Hi, sir. This is Sonal Minhas. Am I audible?
Yes, please.
Yeah, absolutely. Yeah.
So, sir, I am looking at your GNPA movement table, and two things around this. Wanted to request you that if, from a disclosure perspective, if going further, you can actually classify these additions by the four sectors that you are primarily working in, which is gold, corporate, SME, and retail, so that we get a sense of incrementally where these additional slippages are coming from. So that's one. And the second one is linked to this, that if we consider last quarter, this quarter, you could throw some color on where largely these additions are coming from the segments that you talked about, from the retail and gold segments. That will be great. That will just help us understand the business gross NPA movement.
Yeah. Now, to answer your question, I don't think any bank gave that level of details. That is not in public domain in mostly. But to give you a color and a flavor, because this is a call which is open to all, we had a little bit of an extra slippage on one account in Q4 and Q1 for the same customer. in wholesale. But after that, it has been pretty much consistent. See, gold slippage doesn't happen much, right? Gold SMA happens, but then eventually we recover, so it doesn't slippage. So gold is very limited. Wholesale, after that, nothing much has happened. In SME, very this thing. There has been a little bit of a slippage which has happened on the retail and agri and MFI, but that is going to be on a declining trend for us now onwards. And given the arrangements we have on MFI and credit cards, I will leave it at that this slippages does not necessarily always lead to, it leads to NPA, but it doesn't lead to loss. Okay. So given all this perspective, I'm not so worried on slippages on credit cards or MFI. But yes, some of the retail loans and agri what slips will lead to loss, but that is sort of stabilizing. It will stabilize from next quarter onwards. So to that extent, I'm pretty confident of my slippage number and the GNP and NNP and credit cost number from now onwards. I feel that this is where we will be, unless there is some big ticket which hits us, which is not today. We don't know of that. Okay. So that can happen always, one case here, one case there, and on a small balance sheet we have, one case can create some noise. But right now, we are not aware of anything right now.
I understand that, sir. So, the second question is a little bit longer term, 2-3 years out kind of a question, which is linked to your CASA, because if you understand better than that if the deposit franchise is largely term deposit linked, there is a incremental level of cyclicality in your business compared to large banks which do CASA. And so just wanted to understand, what does it take on the ground for CSB to mobilize that? Is that a part of the agenda? And where are the constraints? Just trying to understand the subjective part of it as you see yourself growing and becoming like a new age bank going for the next 2-3 years.
No, thanks for the question, because I try to respond to this in almost all the calls. And this is the biggest part of the strategy of the bank. So if you look at it, our growth in SA has been around 9%. Our growth in deposits is well above 30%.
Yes.
So 9% is not bad, but it is bad when it comes to looking at overall deposit growth of 25% when you have taken, and hence the CASA ratio do come down. But none of this is franchise business, if you ask me. Franchise business will start, and I would, after this call, most of the questions you have answered, I would like our technology head, CTO, to come and spend 5 minutes on giving what we are doing in technology, because now we are definitive about what we are doing and how it will help us, the bank. Because we are creating a new bank. What we are doing right now is managing the bank as it is. Come FY27, 26, mid of 26 onwards, will be a completely new bank. Okay. And that's the time what you're asking is exactly will go to play out. And most of the people who are in the bank right now, or who have joined the bank in the last 1 or 2 years, they've all been part of building large franchise in very large organizations like HDFC, Axis, and things like that, ICICI. So we know what it takes to build that franchise. And the reason I'm saying that our retail, which is today 20%, but not really 20%, because what question Mona asked, that loan against security, which is gold, if you take that out, it is not even 20%. That has to go to 30. So effectively, a 15% has to go to 30, and that can happen when you build a CASA franchise. CASA retail assets cannot be built without a CASA franchise, because you need customers. And that is something which will happen FY26-27 onwards, where significant focus on customer acquisition will be there. And that's where we know that the larger franchise has to be built pan-India. That's why we are creating distribution. And a lot of those branches are not still fully productive, because we don't have the systems which is required to be making them productive in building the CASA franchise. But we have to put all investments together so that all of this has to culminate into results FY27 onwards. So we are putting all of that investments in today: people, technology, leadership, products, and distribution. So once the CASA franchise starts picking up FY26-27 onwards, and then retail assets will start picking up, then payment products will start picking up, granular fees will start picking up, and then the real retail franchise will start building up. So that's the plan. And we are just waiting for our, I'll not preempt this. I will like Rajesh Chaudhary, who's our head of technology, to give a briefing on this, that what we are doing on the technology side, and what we need to, but we are keeping the entire readiness for the rest of the bank to leverage that technology to build that retail franchise and the CASA franchise. So I'll give you the roadmap. So the vision that the retail franchise and retail businesses will pick up from 15% to 30% will be little back-ended from FY27 onwards. Wholesale is a relationship business. We of course need technology there. We of course need transaction banking there. We need a lot of products, fees and everything. But still it is a relationship business. So next year onwards, you will see the wholesale side will start picking up faster, because even without full play technology, they can build businesses. SME business already without full play technology, they can start business because they are already picking up. Retail we are skipping for the last, not only because we are not fully ready on the technology, also we want the picking of the cycle to happen in retail, and that can only happen when the overall growth in the system comes down below 10% on retail. That's the time we will enter the market in a big way. And that will happen in a in both in terms of liability, customer acquisition, retail assets and all of that, because we don't want to go out and build businesses through DSAs and purchasing asset businesses and all that. That's not the way we'll build it. And gold business will chug along the way it is growing, around 10-20% growth. And but as a mix, it will come down because rest of the businesses will grow much faster. The picking of retail assets businesses will happen in the end of the decade, last 3 years. Wholesale will start picking up from next year. SME will chug along and gold will chug along. That's the way the entire franchise is going to be built.
Got it, sir. So I have a follow-up question on car and car. Just fitting with this into, as you were talking, wholesale doesn't require technology. Splitting car and car, do you also require heavy lifting on technology for car? Or because you are fairly ingrained in the South market, in the micro markets you have been. So that's one. And for same is for SAR, because you've been in Kerala for more than 100 years. So that I thought the deposit side is more a trust-based business than a technology business. So correct my understanding on that. I'm wrong on that. Just on the liability side, actually.
Yeah. So let me tell you, you can either buy business by giving higher rates in SA, okay, or you can build businesses by making SA as a float based on various activities he's doing with you. So the first is not the best way to do business. The second is something which we'll attempt. That's why you'll see our savings account rates are lower than, are not very high. I mean, effective rates are also not very high, somewhere around 3% net rates across the portfolio. So given that, our thinking is the second model is what we'll build. And it's just not trust-based, it is usage-based, it is float-based. It has to be, you have to have your EMI, you have to have usage of that account. And for that, we have to launch salary accounts, we have to launch various payment products, we have to launch various asset products, we have to get those EMI through it, we need to do those transactions through it. In a way, car is no different, because you need technology, because you need CMS, you need supply chain, you need transaction banking, you need rationale for usage of those accounts by a customer, and you have to have those kind of franchise, those kind of customers penetration. That will happen through wholesale and SME. Of course, we'll have retail kind of a car also in branches, but unless we are able to give a better service, unless we are able to give a better turnaround, unless we are able to give a better transaction banking kind of products, be retail or SME or wholesale, it's not sustainable. So that's the way the CASA businesses are always built and will be built. We will not play the price game ever in CASA. CASA anyway, car you cannot play the price game, but SA will not play the price game. Because CASA is just not a liability. CASA is a franchise which helps us in building the assets business. Otherwise, we have to go out and buy businesses through DSS, which I will not do. So customer acquisition is going to be the biggest play in this bank starting FY27 onwards, 26-27 onwards. The start will happen in 26, and 27 onwards it will take off like anything, in terms of customer acquisition. And then onboarding those customers, deepening those customers. For that, we need the right solution, right products, right systems, right turnaround time, and right products. Okay. So that is something which is the CASA franchise, which you are probably asking the question. And CA is no different to SA, it's just a different kind of a segment which you need to focus on. So that's what the strategy is. We don't want to take a shortcut route to any of this right now. That's why we are saying that we'll do businesses, what we understand, what we can do, and hence wholesale will start picking up next year. SME has already picked up. Gold we understand will continue to do well, and retail is something we'll pick up only when you have the CASA franchise momentum picking up.
Important, sir. If I may just ask a short question, the last one. Who's your credit card partner? You specifically mentioned you partnered with somebody.
Yeah, we started doing it with both OneCard and Jupiter. Right now, we are servicing the portfolio which we have done with OneCard. We are not adding any more cards with OneCard right now. And with Jupiter, we are continuing to add more cards. But it's not a huge portfolio. Let me tell you, credit card, microfinance, and and personal loan, all products together is somewhere close to 1,000 crores. Okay, so it's a very small business for us, and we are not growing any of these businesses that much.
Understand that. Okay, I'll call back in a bit. Thanks for answering my question.
Sure.
Okay.
Sure.
Thank you. A reminder to the participant that you may press star and 1 to ask a question. Our next question is from the line of Shivaji Thapliyal from Yes Securities. Please go ahead.
Yes. Good evening. So I just had some basic questions around guidance. Because I think basic numbers are always helpful to learn about. So just wanted to, we've already got sense of the margin, but what would be the overall loan growth guidance, number one, for FY25 and if possible for FY26? And, these are all, sort of near to medium term guidance that I'm seeking. So firstly on loan growth, secondly, credit cost obviously is evolving and, some of the loan books are not seasoned. So, so just wanted to understand where the number do you think will end up for FY25 and if possible, if you can get a sense of FY26. And
yes.
Thirdly, on cost to income ratio also, of course, again, very, number that is evolving as we speak this year and next, your sense on these three aspects: loan growth, credit cost, and cost ratio.
Yeah. So Shivaji, first, let me start with, thanks for your question. Let me first start with what guidance, not guidance, but what ballpark strategic vision which you have in the bank.
Sure.
I'll just repeat it and then answer your question. The strategic vision is that, what we are aiming to is GNPA and this is by 2030. GNPA 2%, NNPA 1%, credit cost 40 basis points. Credit cost to income below 50%. Then SME, wholesale, gold, and retail. I've already said 30, 30, 20, 20, 30. Retail 30, wholesale 20, gold 20, SME. NIM, I've always said that medium term will be between 4.5 to 4.8, and longer term will be 4 to 4.3. Okay, I'll tell you the reason for this. But now, based on Mona's question, I've said that because when we gave this guidance, we didn't know the impact of the penal interest. Because of the impact of the penal interest, we have to wait and watch how this plays out, and hence it could be coming down between 4.3 to 4.5 or 4.6 because of this reason. So we have to see how this plays out now. Similarly, in the long run, it should be remaining between 4 to 4.3 or something like that. And the reason for that is business mix will change because as we move towards from our wholesale from 23% today to 30%, obviously your NIM will start coming down on that. So will cost to income start coming down. A healthy, good portfolio will be somewhere around for us, our kind of franchise by 2030 will be 4 to 4.3, cost to income below 50%. And then ROA will retain the same thing, 4.5 to 4.8, because whatever you do, the ROA and ROE has to be sustained. ROE between 15 to 17%, ROA between 1.5 to 1.8. But some of the components within the ROA tree can make a change based on the business mix that will change. Your question on near term, next 2 years, I think next 2 years, nothing much will change because none of these mixes are making so much of a change right now. So given that, I think our NIM will be somewhere closer to 4.5 once the interest rate starts coming down, the deposit interest rates. As I said, explained before, the elasticity on the asset side, we are lesser inelastic, so we don't have to pass on everything given our book. And our fee businesses will keep going up. I think we'll do even better than today on the fee businesses. And hence, I will not be surprised if we go to 19 to 20% of our overall income as fee, and that's what we're targeting. And on the NPA side, I said that we'll not touch 2, 1, and 0.4. We are now around 15, 16 basis points. I think we'll retain below 20 basis points on the credit cost for a while now. And GNPA, I think sort of we are peaking out GNPA and NPA we are peaking out. That's where I think we should be remaining in the next 2 years. But longer term guidance, because once your retail starts picking up and all that, credit cost will also start going up a little bit, but it will give other businesses, because in retail businesses what happens is your for the same customer you get a lot more businesses, and hence the ROA is sustained between 1.5 to 1.8 is really sustainable. So that's the way we are planning our overall strategic ratios.
Thank you.
What I'll do, Shivaji, if there are no further questions, is I would request our CTO, Mr. Rajesh Chaudhary, because we have put one slide on the investor presentation on technology transformation at CSB Bank. So very quickly, if you can just take 2 minutes to 3 minutes for Rajesh to explain what we are doing on the technology side, because this is the biggest story going ahead, what we are trying to build in the bank. So can I hand it over to Rajesh for maybe 3-4 minutes to give a brief on the technology side?
Sure.
Yeah, over to you, Rajesh.
Thank you for that. Good evening, everybody. This is Rajesh Chaudhary. I'm CTO for the bank. So in March 2022, we put the IT strategy to the board, and since then we have been executing that strategy. What we are trying to do is we are replacing almost all the systems in the bank. And the slide which we have put across, there are 4 different dimensions over there. So one of the dimension on the top left talks about the entire technology infrastructure what we are changing in the bank. So as part of that, we have built 4 data centers, 2 in Mumbai and 2 in Chennai. All the data centers are ready and operational. We have also set up private cloud for the bank, which is also ready for use now. All the bank branches across the country are running on high resilient bandwidth, which means that if something goes down, there is a resilient bandwidth and the business will keep on happening. As part of the transformation program on infrastructure, we are replacing all the hardware for all the servers in all our data centers with the modern cutting-edge technology, which very few banks in the country has. We have also set up a very modern technology command center in our new Turbe office in Navi Mumbai, which is monitoring the entire bank, the entire technology estate of the bank. So that's the tech transformation from the infra perspective. Now coming to the core systems, which is the big story which our MD also spoke about. We have invested in one of the most modern new core banking system from Oracle, which is called FlexCube. We started implementing this from January this calendar year, and we are currently halfway, and sometime in Q1 FY26, this system will go live. Along with this system, we are also setting up new payment systems, a new digital channel system, which means new mobile banking, new internet banking, all of this. We have got a very, very old database in the bank, which is almost like a 17-year-old, similar to the core banking what we have. And that has got significant limitation in doing business today. So we are replacing that with a modern database from Oracle. That will also help us in going ahead significantly. Along with this, a new trade finance system, we are setting up a new finance management system from Oracle, which is called Oracle General Ledger, which will also go live by Q1 FY26, and the new risk management system called OFSA that will also go live in the first quarter of FY26. So we spoke about the infrastructure, then we spoke about the core system, but there are a lot of systems which are surrounding the core system, and we are replacing almost all of those. Some of those have already gone live. So we are setting up lending systems for all the various products. So gold, two-wheeler, LAP, these systems are live and remaining are under implementation. Our lending system for corporate and SME is already live. We have a lot of systems for various support functions. So our new HR system has already gone live. New compliance system is live. We have set up a digital customer onboarding system, which helps our customers to have better experience while joining the bank for any of the services. And we have set up new digital call center in the bank, which is ensuring that our customers are being serviced in a better way. We have set up very sophisticated ServiceNow platform in the bank. This is one of the leading enterprise in the world, and we were told we are the first bank in the country to implement finance FSO module from ServiceNow, which gives us immense agility to launch new capabilities, new system on this platform. So this platform has gone live, and we are setting up one by one multiple systems over here. There is another capability, which is the API ecosystem. So API ecosystem combined with enterprise service bus, this gives us enhanced capability to work with our fintech partners or any other partners, which will partnership strategy is one of the key part of the SBS 2030, as our MD spoke about. So API ecosystem and enterprise service bus will ensure that we are able to integrate our partners in a very seamless and efficient way. And all our systems will also talk to core systems in an effective and efficient way through these integrations. Then, of course, while all of these business systems are in place, infrastructure has been transformed, cybersecurity is sitting at the center of all of this. We have invested significantly in various areas of cybersecurity. We have got our new security operations centers already installed and implemented, from where we are monitoring the entire bank and also checking if there are any threats coming from the external world. Various systems on the perimeter level, on the internal level. We are checking the dark web if there are anything from the bank-related information sitting there. So very, very intense focus on cybersecurity systems to modernize the bank. So this is a very summary, very high-level view on the technology transformation in the various areas what we are doing right now.
So this is in a summary what Rajesh covered, but actually we can have a full day on what we are doing on technology, because I really believe the bank has to be built on the back of a very strong technology for better efficiency, cost, and scaling the bank in a faster turnaround time with a better service. So with that, Shivaji, if there are any further questions, we'll be happy to answer.
Sure. Thank you, sir. Our next question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, I just have two follow-up questions. So firstly, if I could get the mix of loans between EBLR, SPLR, and fixed rate.
Roughly, I remember that our fixed rate is around 70%, roughly, very roughly, but I'm getting around 70-30. 70 will be around fixed rate and okay. So we have floating rate is around 38.2%, 61.2% is fixed rate. Out of that 38.2, EBLR is 10.2%, MCLR is 24%. So 24, 10, 61.
24%
is my
MCLR.
MCLR is 24.41, EBLR is 10.22, base rate, T-bill, MIBOR, LIBOR, so far, all these are around 3.84. All these totals up to 38.20. And balance, which is 61.80, is fixed rate.
Got it.
But here I would like to also say, Mona, here I also say that it looks like fixed rate, but gold loan is a slightly shorter tenor product. So you have to take it with a pinch of salt. Having said that, gold loan prices also, even when interest rate goes up, it doesn't go up. Interest goes down, it doesn't go down that much. So to that extent, it remains fixed only, even if it is a shorter tenor product. So that's why you can call it a fixed rate only.
And just secondly, while you mentioned that, the penal interest impact is still there on the margin, but when it comes to incremental gold loans, are we able to reprice it at a higher rate?
Mona, what happens typically is this is a customer psychology. People, it's a competition, right? So if everybody says that, okay, it is impacting me by 25 basis points and hence we'll raise our rate by 25 basis points, but market doesn't operate like that, right? So if the whole market does it, we'll also do it. But ultimately, we're in a competitive market. So I think it is a permanent damage to the NIM of around 25 basis points for banks with our kind of a business mix. But we will figure out a way to manage the ROA by improving our fee businesses. But increasing because of these rates, I don't think the whole market will operate like that.
Got it. And what is driving such strong fee lines in your case? It's now almost 1.8% of assets, which is like very, on the higher end of what we see in industry and very comparable to large private banks. So, what's driving this fee income?
At least somewhere we should be in the best in class, no? So when I joined the bank, you remember, Mona, that we were core fee used to be below 5%. So we have now taken it up to 17%, 18%. I think we can go up to 19-20%. You can give some credit to the leadership team which you have built, who understands these businesses very well, and still some more to come, because once the retail asset businesses starts picking up, you will see more fees. Wholesale business, generally, good wholesale business run by good banks, and we have all worked in good large banks, can be up to 1.8 to 2% comes on the fee side, right? We actually did a syndication last quarter. Okay, you may or may not believe this, but this is the kind of expertise we are building in the system on the wholesale side. So some of these fees, whether it's transaction banking fees, syndication fees, processing fees, insurance fees has been doing very well. There are 4 such large companies between ETLI, HDFC Life, ICICI Pru, and now Max. There's a reason that they are tying up with us or they are chasing us, because we are doing well. They are seeing the kind of a process which we are following to do all this. And believe it or not, we had only 4 complaints which we resolved in insurance after doing so much of business within turnaround time, and we have 0 pending complaints right now. So that's the level of our persistency ratio is one of the best in the system. So given all these things, we know how to run these businesses. We know how to run many businesses, but till Rajesh delivers all the systems, we're not able to do it. At least these things, we are leveraging somebody else's systems to do it. To do some of these businesses, we don't need our systems, right, when you do insurance businesses. So at least where we can do well, we are doing well right now. So I think that's how it is. I see it sustaining. Take the core fee business. Core fee business for us is around 15% of the total income. I see it sustaining, if not growing, going ahead.
And just one final question. So when it comes to, the corporate book, you mentioned that, there's some reboot going on which led to slippages in the past quarter. So could we have some more of these in the ensuing quarters, or you believe that this is done with the retake and slippages related to that event?
Mona, I wish I could say that, nobody can do a crystal ball gazing, but whatever we can do, we are doing. So we can always have a surprise item, but I think we are doing whatever best we can, and that's the reason I said that last 2 quarters we have been exiting relationships which are perfectly, regular businesses, and they are not NPA, they are not even SMA. We just exited a very large relationship just because, and there is no NPA, no SMA there, but we just exited. Maybe once it came to SMA, but we exited just because we think that that's not the line of businesses we want to follow. So we are completely changing our wholesale franchise business in a different way. Having said that, a legacy book where something will fall, we don't know. That's why we are granularizing. I mean, any large businesses in wholesale which we have done in legacy, we are gradually reducing that, and and hence the shock, if at all, if there is anywhere which we don't know of, is going to be very low. I would like to also add one more point, that we have 183 crores of contingency plus beyond regulatory mandate provision. Out of that 106 crores, 105 crores we have taken under COVID provision. Now there's no COVID, so we have put it under contingency of 105. And what we did is, wherever we thought stressed accounts, now stressed accounts does not necessarily mean that they are NPA accounts or they are SMA accounts. Anywhere we didn't feel good about it, we kept those accounts under those. Out of that, one big account is gone, but we are trying to put some more accounts into that to retain that. So we are taking a very conservative provisioning policy. Otherwise, we could have written back a large amount and improved our PCR. We are not taking that route. We are doing in such a way that we will add some more, so that if there is an accident somewhere, which we don't know yet, we have already provisioned that. So that's the way we are following a very strong, very conservative provisioning policy. Beyond that, who knows? I mean, somewhere something happens, we can't say anything. But truthfully, we don't know anything which can just hit us anytime. If we know, we will exit that relationship.
Sure, got it. That's pretty clear. Thank you so much. Thanks, sir.
Thank you. Our next question is from the line of Sonal Minas from Prescient Capital. Please go ahead.
Hi, sir. Thanks for taking my question again. I had 2 questions. First one is linked to your PCR. I wanted to understand, what is the steady state PCR that you target, or there is a direction there that you want to head to? Because given your chart, given how we see this, PCR excluding write-offs has been coming down. So if you could just explain that a little bit, that will just help to understand this.
See, PCR, our targeted PCR is somewhere between 70 to 72%. Okay. We'll get there sometime next financial year. We were there, but I talked about that one account slipped, okay, which is a legacy account, which led to this problem. Either we'll recover or we'll write off. So naturally, mathematically, this will go back to somewhere close to 70%. We had choice, as I just explained before, from a contingency provision, because one of the accounts we have just exited. We could have written back some of the provision we had taken against this, but we'll add some more provisions and we'll retain it at contingency, because if you move from contingency to incremental provision, conservative provision, we can increase our PCR very easily. These accounting principles are there. But from a board perspective, we have said no. We'll not use those routes to artificially raise PCR. We'll raise the PCR only by either collecting or provisioning, which is not under the contingency provisioning. So we have a very easy method of doing it, but we are not doing it today. So I think our model is around 70 to 70, without PWO, 70 to 73, somewhere around that we will be there. But we will take little time, because we hope to recover some of this. If we can't, anyway, we will do a provisioning or accelerated provisioning and move on. So that's the way we'll plan it.
Got it, sir. Thanks for explaining. And the second question is regarding the LTV for the gold loan. I see this is coming down over time, but just asking you subjectively from an operational perspective of risk assessment, of let's say, credit worthiness of the customer, what the gold is given as a collateral. Basically, are we there in terms of systems and processes and technology for gold loan, or there are still some hoops to cross for us to say that our systems are at par or better than, let's say, the other large gold loan players in the market? Just trying to understand the system basically.
Yeah. No, thanks for the question. Let me put it this way. Given that gold loan is anywhere between 44 to 50% of our bank, depending on where you take that loan against security business, but effectively it is like a gold loan business. It will be only prudent to ensure that we have the best systems and processes, and it's unbelievable amount of work we have done in the last 2 years in gold loan business. From being an average gold loan player to probably we think we are one of the best compliant gold loan business right now. And that's the reason I said in the beginning of the call, or maybe some of the media were saying, I don't remember, that we have put so many things in place in the gold loan, this thing that when this RBI circular came, we found we tick most of the boxes proactively. Okay, so that's the kind of work which has happened in this bank on the gold loan side. But being a very touch and feel physical distribution oriented business, you can never say that we are 100% there, because where somebody is sitting somewhere, what he is doing, we don't know. We can only find it through proper audit process and proper review mechanism, which we are expanding, and we are expanding our scope of audit everywhere a lot more. So let me put it this way. From an intent perspective, we are 100% there. From a process perspective, we are 100% there. From an execution perspective, maybe we are 70-80% there, rest 20%, it can never be 100%. So we are trying to see how we can inch it a little bit more over a period of time. Having said that, on your question on LTV, let me say that actually we are close to 70% on LTV right now. It varies every day. I see a different number, 70, 71, 72. But we also do a sensitivity analysis constantly. What if kind of a scenario on the gold loan price? And that data I see every day. And of course, the retailer and everybody else says, CRO, everybody sees this data. We see two data every day. One is this and one is the LCR data we see every day. So given that our tonnage increased by around 10% and our growth was around 28%. So obviously you can understand that we focus on tonnage because that's the real growth. And the gap between 10 and 28 is because of the value of the gold. Now, one can argue that given what's happening globally, next 1 year, there are no risk. Next 1.5 years, there are no risk. But who knows what is going to happen. So given that perspective, I think we continue to do the sensitivity analysis, and we will take action as and when we require proactively in case we see there is a risk on the gold price, because we have to be sensitive to that 10 versus 28, that this gap of 18% is growth is because of nothing much we are doing. It is happening because of the environment, and it can happen the other way around also at some stage when the gold price starts falling. Hopefully by the time that phase comes, we will be ready with our other businesses by FY26-27. So to that extent, we are just switched spot at this point of time.
I understand. And sir, on the gold loan business reconciliation side, at the branch level, let's say if the loans are being given against the right collateral, or let's say hypothetically we're saying that the value is actually not what the loan amount basically commensurate to the value of the gold that is given to you or deposited with you. What are the systems basically to just check that? What is the periodicity of those systems? If you could broadly highlight, and I don't want to take too much of your time, but broadly just...
Let me put it this way, that I understand your question fully what you're asking. Okay, that is exactly what we have worked in the last 2 years. So it starts with intent. It's what starts with compliance. It's what starts with what we want to do. And then next part is what is being done on the ground, right? So if we take action on anybody who's not following the process right, if we have a very strong audit periodicity in every branch, if we have a signs of saying that where we have more fraud prone or this thing, and if you take staff action the way we need to do it, then you have a much better control. So let me put it this way, I think we have very, very strong controls on our gold loan business at this point of time. Obviously, the kind of pedigree which our management has, intent will never be an issue. The kind of board we have, the kind of promoter we have from an intent perspective, we are 150% there. From a process, policy, taking action, controls, audit perspective, we are 100% there. Still, can I commit that there will be zero fraud? or there will be scale of finance, there will be something where something is going wrong in some branch here, some branch there. In a distributed setup, that can always happen. But our view is that we catch that and we take action, which deterrent that. Deterrent is the biggest thing, which deters people from doing wrong things. But if management looks the other way when something is happening, then there's a problem. Our bank don't believe in that. So that's the best way to handle this business when we're doing it that way.
I understand, sir. Thanks a lot for explaining. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to the management for closing comments.
Thank you, Shivaji, and thank you everybody for asking very relevant and very good set of questions, I must say. We are very excited the way the bank is turned around in this quarter, and we are very committed to hopefully show even better performance next quarter. Thank you very much and have a good evening.
On behalf of YES Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.